HSBC's earnings delivered a number that the market had not fully priced. Credit impairments rising $400 million to $1.3 billion in a single quarter, with $300 million of that directly attributed to Middle East uncertainty. The surface reading of HSBC's results was deceptively mixed. Revenues rose 6% to $18.6 billion, net interest income climbed 8%, and the wealth division grew fees by 18%. That combination would normally be enough to hold a bank's share price. Pre-tax profit fell instead to $9.4 billion from $9.5 billion, missing forecasts of $9.6 billion, and the miss was entirely driven by the impairment line. That specificity is what moved the sector. This was not a trading loss or a revenue shortfall. It was a deliberate, quantified provision against a geopolitical scenario the bank's own risk desk judged likely to persist. When Europe's largest lender by assets builds a $300 million forward allowance for Middle East deterioration, the question for holders of Lloyds, Barclays, NatWest, and Standard Chartered is not whether HSBC was right. It is whether their own books carry similar exposures without yet reflecting them in guidance. Domestic institutional flows interpreted the result in exactly that way. HSBC shares fell in Tuesday's session, pulling the broader UK banking sector with it. The selling was not indiscriminate panic. It was sector rotation out of UK-listed financials, whose international loan books are most exposed to Gulf trade credit risk VARs. The FTSE 100 dropped 1% to 10,257, with banks the largest single drag. What the impairment announcement does not resolve is whether this is a one-quarter adjustment or the beginning of a multi-quarter repricing cycle. HSBC's own language, heightened uncertainty and a deterioration in the forward economic outlook due to the onset of the conflict, was forward-looking. That framing leaves the provision line open to further increases if the Strait of Hormuz remains constrained. The ceasefire that was still partly intact when the quarter ended has since fractured further.
The same session that punished UK banks produced a 4.1% gain for Babcock International and a 2.7% rise for BAE Systems on unchanged fundamentals against a falling index. That divergence is the mechanism the HSBC chapter left unexplained. If the market were simply de-risking on geopolitical fear, defense names would not rally while banks fell. What it reveals is that two distinct capital flows ran simultaneously through the FTSE 100, institutional selling of bank positions as credit impairment risk repriced upward, and tactical buying of defense equities as traders positioned around a prolonged conflict timeline. Neither flow is purely sentiment-driven. The bank selling is anchored in the HSBC provision number, a hard earnings signal, not a fear proxy. The defense buying is anchored in a specific positioning logic. If the Strait of Hormuz remains partially blocked, UK government procurement timelines for naval and air defense assets accelerate. BAE Systems is the primary UK beneficiary of that scenario. Babcock's naval maintenance contracts make it the secondary. The intraday narrative added a further complication. Axios reported in the afternoon that US and Iranian negotiators had reached a proposed 60-day memorandum of understanding, a ceasefire extension rather than a resolution. The FTSE 100 partially recovered towards session end, but defense names held their gains even as the broader index stabilized. That tells the participant structure. Defense buyers did not treat the MOU as a reason to exit. The 60-day framing is itself a signal. It implies the underlying nuclear and trade negotiations will remain live through summer, sustaining the defense procurement thesis regardless of whether active strikes pause. The frame that connects banking selling and defense buying is duration. Banks are marking losses now. Defense stocks are pricing a contract pipeline that does not deliver for 12 to 24 months. The rotation is not risk off versus risk on, it is a time horizon split within the same war thesis. What this chapter cannot settle is whether the duration trade holds if the MOU progresses to a full agreement faster than the 60-day window implies, and that question connects directly to the credit provision HSBC has already booked.
B&M European Value Retail reported a 47% fall in pre-tax profit to $227 million from $431 million, and still surged 15% to become the best-performing stock in the FTSE 250 on the day.
That result is not a paradox. It is the specific structure of how short positioning unwinds. B&M had been one of the most visibly shorted names in UK mid-cap retail, with bearish positioning built on the back of consecutive profit warnings and a 26% adjusted EBITDA decline. When the full-year results landed with an LFL sales figure of minus 0.1% against a consensus forecast of minus 0.4%, the beat was narrow in absolute terms, but decisive relative to the short case. Free cash flow held at $321 million, net debt fell 16% to $656 million, and Q4 UK LFL turned positive at plus 0.1%. The short cover flow, not new buying conviction, accounts for the magnitude of the move. Retail institutional holders of FTSE 250 passive products were the absorbing side. B&M's weighting in the index meant the share price rise redistributed passively, without active buying decisions at the margin. That combination, shorts exiting, passive absorption, and index weight mechanics, produces the 15% gap without requiring the fundamental picture to have materially improved. What makes this session's B&M move relevant to the wider FTSE picture is the contrast it exposes. The market that sold HSBC on a concrete earnings miss simultaneously rewarded B&M for a smaller-than-expected profit collapse. Capital moved out of international credit exposure and into domestically insulated, low-multiple UK consumer names, even names with deteriorating fundamentals, as long as the deterioration was less severe than priced. That is a rotation signal, not a recovery signal. The verification benchmark for the day's dominant reading is the Bank of England's June 18th rate decision. Markets priced a 90% probability of a hold at 3.75%. If the BLE signals a later cut timeline than currently discounted, citing PMI contraction at 49.3 alongside elevated energy costs, the bank selling deepens and the domestic consumer rotation loses its floor, because B&M's cost mitigation plan depends on energy cost stabilization that a prolonged Hormuz constraint does not deliver. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.